Hello, everybody. My name is Steve Philp, and I'm the Partnership Director here at Portugal Pathways and your host for today's webinar, which is Tax and Estate Planning for Life in Portugal. Before we get going and I introduce you to today's panelists, just to let you know that today's webinar is being recorded. So if for any reason you need to drop off earlier, we will be sending out a replay of the webinar within the next sort of 24 to 48 hours. Obviously, we encourage you to leave questions in the chat and comments in the chat. We've got a Q&A at the end. If we don't get round to all of those questions, and then someone from our team will obviously pick those up and reach out to you individually. Obviously, today's topic is around tax and estate planning, and that is going to be very specific to each individual on here. So if you have anything that you'd like to discuss on a high level basis or anything specific about your estate planning or any tax queries that you may have, throughout today's webinar, we'll be putting a link which will enable you to schedule a no obligation discovery call with an expert to talk about your personal situation. So let's get going today. In terms of your panelists, firstly, I'd like to introduce Paul Stannard. So Paul is the chairman and founder here at Portugal Pathways and the Portugal Investment Owners Club. He supports international families, investors and entrepreneurs when it comes to relocating to Portugal. Joining Paul, we've got Andreas Pretorius. Andreas is the founder at Pretorius Wealth Management Solutions, and they specialize in cross-border structuring, succession planning, and family wealth strategies for expats in Portugal. And finally, joining Paul and Andreas, we have Nuno Santos. Nuno is the tax partner at CMS Portugal. Nuno brings a wealth of experience in tax law, estate structuring, and legal frameworks relating to both Portuguese and international succession planning. So let's sort of start this webinar off. And Nuno, I'm going to come to you first. Can you sort of tell us why Portugal is attractive when it comes to structuring your income and assets or estate and tax planning?
Hi, Steve. Hi, everyone. Thank you for the invitation to be here today. Look, I think that Portugal, for quite some time, became a very interesting destination for people that want to relocate to somewhere else. And Portugal has been in the map exactly, mostly because of tax reasons, because Portugal has, since 2009, implemented tax regimes that attract people to relocate to Portugal. So we had, from 2009 until 2024, the end of 2024, a regime which was called the NHR, which we now call it the non-habitual resident, which is, now we call it the NHR 1.0, because in the meantime, it was replaced by another regime that we are now calling it NHR 2.0 or 2.0, which basically allows that people that move to Portugal or people that become Portuguese tax resident, provided that they have not been one for at least the previous 5 years, they can have access to a regime that, in broad terms, basically all the income that they make from out, which is non-Portuguese sourced, it will be fully exempt from tax in Portugal for 10 years. So obviously, if we consider the kind of people that Portugal has been attracting, which is basically high net worth and ultra high net worth individuals that have their own companies abroad, from where they get dividends, they may get capital gains if they decide to sell the company or if they have some kind of IPO. You can imagine that why is Portugal so attractive? Exactly because those people can move to Portugal and pay zero tax on a capital gain or on a dividend or a rental income that they would get from non-Portuguese source. On top of this, Steve, Portugal has no inheritance tax nor gifts tax when the beneficiaries are the descendants or the spouses, and that's obviously another big advantage that people take into consideration. Mostly when you look at other countries where the inheritance tax rules are in some cases very aggressive, And also Portugal does not have any wealth tax, which is another big advantage. So if you combine that with other legal regimes that Portugal has been implementing over the years, like being the most famous one, the golden visa, I think that we can easily see why Portugal is clearly on the map when it comes to tax and estate planning as well.
Thank you, Nuno. That's a good overview there. Andreas, obviously, you're working with discerning families with complex lives and with multiple assets internationally. Could you sort of walk us through some of the most common estate planning and wealth management mistakes that you see from expats in Portugal?
Yeah, hi Steve, and good afternoon to everyone, and thank you for hosting this. Yeah, I would say you've also got to consider, echoing what Nuno just referred to, the influx of foreigners that was created through these tax incentives by Portugal. You've got to recognize the demographics that it was looking to initially attract, and if you consider the tax exemptions, particularly on the pension front, it meant that there was a large majority of the populations that were coming into Portugal tended to be retired or early retiring people. And on that basis, one of the things that we've identified, the sort of mistakes, as you've alluded to, is firstly, not planning, not being prepared. The initial honeymoon phase that is so evident when you have such a generous tax regime has led to a lot of people just kind of falling into the flow of how lovely it is to live in Portugal, how comfortable it is. The tax exemptions just come as a natural phenomena, so to speak, and people tend to not prepare in time, and then naturally inertia sets in, and it just further delays the ability to understand how you need to plan for what may happen post NHR, because it's like one of those things in life where there is a defined period. It is going to end. So your ability to affect and implement things that are going to benefit you post are absolutely there. But for the reasons I just mentioned, that's one of the first things that I've noticed. And then secondly, what has become very evident is, following on from that, not preparing sufficiently or preparing early enough, is the lack of the ability to navigate the constant change that we see in policy, in legislation, even economic events. And this is both from your country of residence now, being Portugal, but equally the host country that you've come from. And so not being prepared in the initial stages just means that the ability to navigate all the changes as they happen becomes a lot more challenging. So I would say those are the two bigger mistakes that I've seen people do, and especially those that have benefited from the NHR regimes, and those that are likely to benefit from the new regime. Need to take the same sort of steps in being prepared early, and that will enable them to navigate potential changes alongside.
Thank you, Andreas. And again, thank you again, Nuno. I think Andreas and Nuno have really sort of set the scene well there. Now, I've got some more sort of specific sort of questions here around laws and obviously how Portugal deals with certain things. And Nuno, could you sort of briefly explain how forced heirship it works under Portuguese law and how it affects expats, obviously, particularly those that already have wills or trusts set up abroad?
Look, I think that when we look, Steve, when we look at this kind of issues, I think we need to look at this from two different angles: the civil and the tax side of things, which do not mandatorily go together. So basically, the civil implications, they determine how a person can dispose of his patrimony. For example, if they can leave everything to their spouse, or if they are obliged, for example, to leave something to their children. Tax rules, on the other hand, they determine in which circumstance gifts and inheritances may be taxed in a given country, and that typically depends on the location of the goods and also the residence of the beneficiaries. So, as you were saying, in respect of civil implications, Portugal has what we call the forced heirship rules, which basically means that a person cannot decide without any type of constraints what to do with his or her estate. For example, in Portugal, you can't just simply disinherit a child. So if someone is living in Portugal on a permanent basis, one of the things that we have been doing, and I think that we will be discussing this in more detail, is, for example, to try and avoid to fall within the scope of the Portuguese civil law. And that is typically done by selecting or opting that is succession, it will be subject to the citizenship law and not to the Portuguese one. And this has to do exactly because Portugal has some rules or some or less flexibility when it comes to deciding what to do with your assets, because this forced heirship that you were mentioning, basically in Portugal, the forced heirs are typically your spouse, your descendants, the children, grandchildren, and in some cases your parents as well. And these forced heirs are entitled to a mandatory share of the estate, which is also known as the reserved share. So one of the things that we have been seeing a lot is the fact that even though Portugal basically what it does is to, in most cases, does not tax inheritance, the truth is that sometimes our clients that move from abroad, and they have, as you were saying, trusts or other kind of wrappers outside of Portugal, sometimes what they end up doing is to take advantage from the tax regime that we have in Portugal, but making sure that the Portuguese civil law does not apply to them, because in most cases they want to be a bit more free than what Portuguese civil law allows them to do when it comes to deciding what to do with their estate. Because as I was saying, this forced heirship creates a lot of limitations that clients sometimes are not happy with.
Gotcha. Thank you, Nuno. Andreas, sort of coming to you now. Can you sort of explain the concept of electing the law of your nationality in your Portuguese will, and why that might offer more flexibility for expats?
Yeah, well, I think that just follows on from exactly what Nuno was saying. The ability for the EU succession regulations to allow you to elect your country of nationality to dictate how the estate that you have is administered and how the succession laws apply to that estate. I think also, as Nuno said, very importantly, it has no bearing on the taxation of that estate. It is simply a ruling as to how your estate may be distributed and administered. So it further lends to the idea of the ability for you to have the control over the decisions of what happens to your estate. And I don't have the latest figures of here in Portugal. I'm very aware of the figures back in the UK as an example, where over 60% of UK adults do not have a will. So if that is in any way indicative of what the situation may be here amongst the expat community, it's important to bear in mind that if you die intestate in Portugal, it is the laws of your country of habitual residency at the time of your decease, when you pass on, that will dictate the administration of your estate, or failing that, the country where you have the closest ties to. So again, the idea of crossing the T's and dotting the I's with just ensuring that you have a will, you've established and made your beneficiaries, your executors aware of what your intentions are. It allows for that control that you get to exercise over the administration of your estate.
Lovely. Thank you. Paul, I don't know, are you with us? You're on mute at the moment. I'm not too sure that we'll be able to get Paul at the moment, so we'll come back to him. Nuno, you're the sort of legal professional on the panel. Is there anything else that you would advise and want our audience to understand, as it's such a sort of a mixed, international audience seen from the polls?
I think there are some issues. I think that following what Andreas was mentioning about some rush decisions that people take when they move to Portugal, one of the things that we see happening as well is that people move to Portugal when they feel that everything now needs to be done through Portugal. So everything should be immigrate. So all assets should immigrate with the client to Portugal, and that typically, based on this NHR 2.0 regime that I was mentioning, that is typically not a very wise decision, because this NHR 2.0 regime, it protects much more income that comes from abroad, which is typically exempt from tax in Portugal, than Portuguese sourced income. So we know under this new regime that in order to even benefit from the regime, you need to have, first of all, some kind of employment relationship with the Portuguese company that operates in specific sectors of activity, and you need that to even benefit from the regime. But apart from what you really need to get from Portuguese source in order to benefit from the regime, you want everything else to be as much as possible coming from outside of Portugal, because when it comes from outside of Portugal, and even though it is fully declared or disclaimed or disclosed in Portugal, it would be completely exempt from tax, with very limited exceptions, like, for example, pension income. So this is the first comment that I would make, just following what Andreas was also mentioning. Regarding inheritance, and as I was mentioning, I think that clients should seek for also some level of diversification of their assets, because there are some kind of assets, such as real estate, that obviously our capacity to be tax efficient when it comes to real estate, it's much more difficult, because most of the countries that we know about and that we have clients coming from, most of the countries are allowed to tax real estate located in their territory. So even if I am in a position where Portugal does not tax inheritance, does not have any kind of inheritance tax, it's very likely that someone that is a Portuguese tax resident, and even the beneficiaries of an inheritance are Portuguese tax residents, if the property is located somewhere else, it is possible and even likely that the country where the property is located may have the capacity to tax this transfer of ownership from the deceased to the heir. So one of the things that we've seen a lot, and I think that Andreas will agree with me, is our clients, that has to do also with some planning on post NHR, have been investing, for example, or setting up some, for example, life insurance wrappers, which are very flexible, not only from a tax perspective, first of all, because you as the person that created the wrapper, you are not taxed until there is an effective distribution. And even if that exists, the level of taxation is very, very limited. But also, these kind of insurance or unit links or life insurance plans, they are also typically very flexible when it comes to the moment that the redemption or that the effective distribution to the heirs occur. And that gives us, for example, the possibility to tackle a situation whereby we have a client that is a Portuguese tax resident. He knows that there is no inheritance tax in Portugal, nor gifts tax, but his son, for example, or his descendants are resident in a place which taxes inheritance. So by having a life insurance wrapper or other kind of structure like this, and trusts also help on this, you may make sure that the distribution does not take place when the person that, or the settler, passes away, but you can predefine other moments in time where that distribution will take place. And that, for example, can give time and room to the beneficiary to even, for example, change their tax residency to a jurisdiction where receiving what the kind of assets that they are supposed to get as heirs is no longer taxed, Portugal or somewhere else. So my point is, I think that when it comes to inheritance, when we have assets that can be more easily moved or transferred, we have typically more flexibility to try and be more efficient when the time comes for them to be transferred from the deceased to the heir. So these would be, let's say, my two my most relevant comments on situations that I have been seeing, and I believe that probably Andreas has been facing the same situations.
Okay, thank you, Nuno. Paul, I think you're back with us. Can you hear us?
Can you hear me?
Yes, we can. We can.
Oh,
Welcome,
okay.
Paul. Welcome. So, Paul, I just want to sort of go back a little bit. We were talking about obviously how we've got a real mix of international individuals in the audience today. So, when obviously living as an expat in Portugal, international estate planning becomes a critical aspect of wealth management, especially when assets and family members are spread across jurisdictions. Again, obviously, looking at the poll, we can see that we've got, US, UK, Singapore, Canada, Hong Kong, South Africa, Indian, and obviously Portuguese in the audience today. What some of the things that are common to all of those, but also some things that are a bit more specific?
Well, and one of the things, common considerations for discerning families that are coming to Portugal could include like aligning wills. I see there's a couple of things in the chat. Sometimes you do need a Portuguese will and a will based from where you come from. Obviously, the other guys have talked a little bit about Portugal's forced heirship and managing cross-border tax exposure is another one. When reporting on foreign assets, and there's some of the things, but obviously Nuno and Andreas would be far more qualified to talk about any specifics.
Okay, Paul. Again, I know that in terms of sort of US connected individuals, that many Americans in Portugal are concerned about the complexities of US estate planning rules, global reporting, and PFIX. How should they sort of approach estate planning in a way that works both in Portugal and under IRS scrutiny?
Yeah, I mean, ultimately, that they're going to be taxed on their worldwide income because they are US connected citizens. But what we've seen, and working with people like Nuno, if they've got a tax advisor in the States, we can work collegiately with them, to join the strategy together. But you have got to treat estate planning much more with much more complexity, because you are in two jurisdictions, and we do find a lot of the time American folks have it pretty sorted at home, but when they come to Portugal, it's not the same, and there are other considerations, and putting effort into that estate planning so they can have some peace of mind for the future is pretty important. And having wealth managers that are qualified, once they have a Portuguese address, that are qualified to give advice, because many people think they still can take advice from a wealth manager in the States. But once they have a residency address in Portugal, it doesn't really, it really isn't regulated advice. So having a collegiate approach with wealth managers that are, qualified to deal with Americans, but also working with tax partners like Nuno and whoever they use at home. But we do have people that are US tax lawyers based in Lisbon, but sometimes it's easier to work with the people with a trusted partner in Portugal.
Very cool. Nuno, anything that you want to come in behind what Paul said there?
No, I fully agree with what Paul mentioned. Obviously, U.S. Citizens or U.S. connected persons are always a challenge for us in Portugal, because even under this NHR 2.0, we may end up with situations whereby the person is getting income which is tax exempt in Portugal, but it would always involve, or it typically always involves, some level of taxation in the US, because as Paul was mentioning, US people typically are always liable to worldwide income tax in the US. So sometimes when we look at the NHR 2.0 for our US citizens, we don't really look at them for them to be in a position whereby they pay tax nowhere. They will keep paying tax in the US. What we want to make sure in most cases is that the level of taxation that they have in Portugal does not exceed the one that they have in the US. Because what happens in the US is that normally the US grants a credit because the US tax people based on citizenship. They also make sure that a US citizen that already paid taxes on income that he received abroad, the US will grant a credit in the US on the tax that was already paid abroad. So what we want to make sure is that by using or taking advantage of the NHR 2.0, at least we make sure that the Portuguese taxation doesn't exist, or if it exists at a rate which is lower than the one that would apply in the US, meaning that there will never be a leakage when you do an arbitrage between rates. What we don't want, for example, is that someone that would come to Portugal and do not benefit from the NHR, and for example, if you would have a Portuguese salary which could be liable to our progressive rates that go up to 48%, if in the US that kind of income is liable to tax, let's say at a 30% rate, the 18% difference would be lost. Whereas if in Portugal I have a 20% flat rate, in the US I have a 30%, I would only pay the 10% difference in the US. So that's what we want to make sure, and that's why it's so important, specifically when it comes to US clients, that the client has at the same time a kind of a consolidated view or approach between a Portuguese tax advisor and a US tax advisor, so that we make sure that nothing that we decide to do does not affect the other jurisdiction.
Thank you, Nuno. Thank you, Nuno. And Andreas, I'm going to move it on a little bit and come across to yourself. Do you have any sort of specific examples of how people have benefited from a holistic approach to estate planning, wealth management, and tax structuring, and maybe why that is so important?
So I'll set the scene for a specific example that I've been involved with of recent, and I think it's important to note, if you consider the three separate pillars that you mentioned there: estate planning, wealth management, tax restructuring. And the goal from an holistic financial planning perspective is essentially to define and help clients to decide what it is the outcome is that they are looking to achieve. So what's the overriding objective? Because all three of those facets of financial planning will have their own very specific attributes. And the importance of being able to align, optimizing all three of those aspects of financial planning becomes a lot more evident if you know what the big picture planning is. So setting the scene as, for an example, couple that had retired to Portugal some time ago with a very healthy final salary pension from the United Kingdom, paying them in excess of 90,000 a year, decided to benefit from the NHR in just coming over, enjoying that tax-free pension income, because they were still subject to the 0% rate of tax on pensions at that point, and leaving the rest of their assets in the UK, being discretionary managed and providing a dividend income that they then received here in Portugal, also exempt under the NHR status. And fast forward post the budget of last year, which was when we were only introduced, it was evident that we needed to first establish what is the wealth management objective? What are we looking to achieve? Because the fact that there was sufficient pension income not being taxed and this additional income coming in from their investments abroad was simply being redirected to the bank in Portugal, which wasn't an optimal solution. for them. So restructuring what they already had in terms of ensuring that achieves a better objective for the future was the first step in just designing what the wealth management strategy should look like. Because alongside that, some intricacies that they were not necessarily aware of was, even though they had this great pension income not being taxed, the fact that they had a discretionary managed portfolio that was buying and selling assets throughout the year meant that they were running the risk of being subjected to capital gains tax on particular sales or trades that took place in those assets within the space of a year. So the buying of an asset and selling it within a year, even though they had a pension that was exempt, that pension still was relevant to dictate the progressive tax rates on which they may be charged capital gains tax on those assets, which could in this case be up to their marginal rates. So helping to restructure that to ensure that they are more compliant is the first thing. Secondly, then, looking from an estate planning perspective, the first thing to do, and what we did, was assess what is their tax liability, what is the likely legacy taxes that they will be liable for, given at that point their domicile, and now subsequent to the changes in the UK budget, what would be the relevance of the long-term non-residency status? And would it be better to retain their assets in the UK or have their assets outside of the UK for future planning from an estate planning perspective? And then thirdly, looking at tax restructuring. So they also had a trust in the UK, which they were not aware of at the time, was what we call a bare trust, which meant that the assets in the trust was not a settlement for inheritance tax purposes. So even though it's a trust, those assets would still have been subjected to inheritance tax in the UK, even if they were resident here or long-term non-resident in Portugal. So that's where, working with the right partners, the right legal teams, the right accountants, we were able to understand how to liquidate that trust, considering Portuguese tax laws on trusts, which, as Nuno will say, is ambiguous to say that's being kind. It's very, very involved. It's subjective at best. But being able to provide sufficient proof of what the intentions were, who the donors were and settlers were and so forth, we were able to actually extract all the capital from that trust with no taxation at all, and redeploy it for them here in Portugal. So all of those factors have to work collectively to ultimately ensure what's the bigger picture goal, the sustainability of their ability to enjoy the level of income that they currently have, with the knowledge that post-NHR on that big pension, there is going to be a progressive tax applied to it. So, we need to save and reinvest surplus funds that they have now in preparing them for post-NHR. So that's just I believe, a good example of how all the different elements of financial planning should come together holistically to ensure that you optimize your personal circumstances.
Thank you, Andreas. Obviously, Joe's got another little sort of question to sort of throw at you while we're on the subject matter. What roles do insurance policies and private investment structures or international bonds play in a successful cross-border estate planning strategy, especially for obviously existing NHR tax holders? Okay, so there's a reasonable amount of knowledge and thoughts out there on the place of insurance-linked and insurance wrappers and what the purposes they ought to serve. What I would stress in the first instance is, again, to ensure that you have the strategy correct, and then you utilize the necessary products, wrappers, platforms to optimize the tax efficiency of your solution, of what it is that you are looking to achieve with your financial wealth. Because as people will know from the US, you have your IRAs and your Roth IRAs, and they provide various tax benefits and incentives. In the UK, you have the ISAs and contributions to pensions and so forth that are tax efficient. But it's very important to understand how and when to make use of them,
That's where, with NHR holders, the opportunity to invest in these insurance-related products as part of the bigger picture planning, I would say it is almost as important to do that as soon as possible, because these wrappers and products have certain time constraints associated with when the maximum benefits become applicable to them. So, there's many cases where I've come across people that do take advantage of these wrappers, but then they start drawing money from them in year 1, 2, and 3. That is defeating the kind of tax benefit of the solution. It doesn't make the solution not a good solution. But in that case, you have the opportunity to invest in a platform alongside that, where, again, if you've got benefits under the NHR, you can structure an income distribution portfolio of assets to provide you with exempt income whilst remaining the insurance product that remains free to grow. With the tax deferral on that growth, adds up over time, and the benefit of a reduced tax rate over time then really comes into play a lot more. So again, it's recognizing what are we looking to achieve, what do we have, and which are the best platforms to put it on, and then act sooner than later.
Thank you, Andres. Nuno, coming over to you, what practical first steps should expats take to align their estate plans with Portuguese tax law, while also sort of preserving international flexibility?
I think that the thing that they do the most, as I was mentioning at the beginning, is first to understand that forced heirship rules that we have in Portugal. And most of the times what they end up doing when they come to Portugal is to have a Portuguese will that does, in most cases, nothing more than just setting the citizenship law to be the one to apply in case of inheritance. So sometimes that is the first step, which is to give the client some peace of mind that something happens to him. In Portugal, we know, or the authorities know, that he opted for his citizenship law to apply and not the Portuguese one, giving, as I was mentioning at the beginning, more flexibility to the destination to give to each asset that the person owns. In terms of estate planning, more from a tax angle, and as Andreas was mentioning, we believe that it is important, as I was saying, not to rush and to bring everything to Portugal. So it's important to fully understand what are the main terms and conditions of the regime, because we've always seen happening ever since the beginning of the NHR 1.0, people coming to Portugal and saying, I moved to Portugal, I'm fully exempt, so I can do whatever I want. And that's not exact. That was not true on the NHR 1.0. That's not true on the NHR 2.0 as well. So the exemptions have conditions, and people need to be aware of what the conditions are so that they are not then caught by surprise when they submit a tax return thinking that the outcome will always be zero tax to pay, and then they get surprises of additional assessment notes being issued. And if you allow me, I think that's also important, because I've seen from the chat that there are a lot of people asking questions about the NHR 2.0, and if I have an income from a specific jurisdiction, do I qualify? It is important to, and when I look at the comparison between the NHR 1.0 and the 2.0, I think it's important, if you allow me, Steve, just to dedicate some words to that. So the NHR 1.0, as I mentioned at the beginning, the possibility to apply for it ended by the end of 2024, and it was already, the 2024 was already what we call a grandfathering year, a transitional year. So people that applied in 2024 only applied because they complied with specific conditions that allow them to be, let's say, late applicants to the NHR 1.0. Those have not been affected by the end of the regime, because for them, the regime will always last for at least the 10 years, provided that they are Portuguese tax residents. When I look at the NHR 1.0, the NHR 1.0 was much more simpler to get access to, because you would only need to become a Portuguese tax resident and not having been one in any of the previous 5 years. you would come to Portugal and you would be exempt on non-Portuguese sourced income. You would be liable to pension. On pension income, you would be liable typically to a 10% flat rate in Portugal. And I would say that the main weakness of the former NHR regime would be the capital gains on the sale of financial assets. And that's, as Andreas was saying, that turned, for example, having insurance wrappers or other structures that allow capital gains to occur not at the personal level of the NHR, but at the wrapper level, which would not trigger Portuguese taxation. That was particularly relevant when capital gains assessed abroad were liable to tax in Portugal under the NHR 1.0. So NHR 1.0, much easier to have access to, but it didn't protect capital gains on the sale of shares, and that was a big issue for a big number of clients that we had with big portfolios of shares abroad. The new NHR, the NHR 2.0, is more demanding because now you not only need to become a Portuguese tax resident and not to have been one in any of the previous 5 years, as you need to combine this with an activity that you will have in Portugal, so from paid by a Portuguese entity, and the entity itself needs to operate in specific sectors of activity, and the person that is applying for the NHR 2.0 needs to have specific positions or relevance or seniority within the company, and the person itself needs to have some academic qualifications to be able to apply for this regime. So it's more demanding to have access to, but I believe that there were some recent changes made by the new government on this regime that turned the regime still clearly able to for people to apply for it with some, let's say, creativity behind. The NHR 2.0 has a big advantage, which is capital gains or any income coming from abroad, except pensions and income coming from blacklisted jurisdictions, are completely exempt from tax. So an NHR 2.0 knows that he will pay 20% on his eligible activity in Portugal, the employment, for example, income that I was mentioning. But on the other hand, if he has any capital gains coming from abroad, dividends, interest, royalties, capital gains on the sale of properties, all of that will be fully exempt from tax in Portugal for 10 years. And this, just complementing what Andreas was saying, it also gives us a bit more flexibility to prepare ourselves for the post NHR 2.0, because under this new regime, the fact that I know that if I transfer from my personal ownership shares that I have in the UK into a life insurance plan, this potential appreciation at the date of the sale or at the date of the transfer is not a taxable event in Portugal. And it used to be if I did that under the NHR 1.0. So my key comment regarding the NHR 2.0, don't take for granted that when you move to Portugal, you are exempt and it's done. It's not mandatorily true. Seek advice to make sure that you really comply with the conditions to have access to it. And then I believe that nowadays you have potentially a bit more time to decide what to do on the post NHR. Let me give you an example, which is also an interesting one when it comes to changing the mindset. And this is an example that I always give clients. And this is true not only on the 1.0, but also on the NHR 2.0. When I talk to entrepreneurs or to company owners, they tell me, I ask them what kind of income do they have. And for example, they own a company, let's say in the UK. And I say, do you typically take dividends out of your company? And they answer, no, because my company is at an investment stage. So I'm using the proceeds or the profit of the company to reinvest and making the business grow. And that's a perfect example of how you need to change your mindset when you move to Portugal under a regime like the NHR 1.0 or the 2.0. I know that I have a 10-year window to take possession of income coming from abroad, which will be fully exempt from tax, okay? So what I always tell clients that explain that they cannot distribute dividends because the company needs the money to reinvest or to expand the business. I tell them, look, you guys need to change the mindset. Why? If the company has profit, the company mostly coming from the UK, where there is no withholding tax on dividends, so there is no leakage on the distribution of dividends, you make sure that you get dividends withholding tax exempt in the UK and tax exempt in Portugal, is if the company is profitable, distribute the dividends to you so that you take possession of the income while you are exempt. If the company needs the money to reinvest, re-inject the money into the company as a shareholder loan, for example, and this will give you a kind of a cushion for the future. When the 10 years are over and you are no longer able to get exempt dividends from abroad, you created throughout the 10 years a big shareholder loan credit over your own company. So after 10 years, you can still remain a Portuguese tax resident, but instead of getting dividends from your UK company, for example, you start getting a reimbursement of the loans that you granted the company over the 10 years while you got dividends and you re-injected the money into the company. So my point with this example is to say that take advice or seek advice on the conditions to apply for the regime, and seek advice from some, let's say, creativity or obviously some track record on advising clients with this profile, to make sure that you really take the most out of the in this case the NHR 2.0 or the NHR 1.0 regime. On the estate planning, again, typically clients end up, when they understand that this forced heirship exists, they end up using Portuguese wills just to make sure that the citizenship law is the one that should apply. And then we typically recommend some diversification and flexibility on the kinds of investments that are made, to make sure that we can fine-tune and give time to the beneficiaries of the inheritance to potentially adjust their lives for them to receive the assets coming from the inheritance within the most tax-efficient framework.
Thank you, Nuno. Very detailed and great overview there. Thank you very much. I'm conscious of the time, and I can see obviously lots of questions specifically around the subject matters that we've talked about within this webinar, and we'll get to those in literally a minute. I just want to remind people that if you want a personal discussion about your own estate planning, then one of my colleagues will be putting a link in the chat and also on the screen for you to arrange that sort of no obligation discovery call, because obviously everybody's personal situation is different, and obviously the advice that you would need would be unique to your sort of set of circumstances. So I said you'll see that link come on the screen. Please click on it and book a call with one of our experts. Now let's get on to some of those questions within the Q&A. Again, if we don't get around to answering all of them, which we're probably not going to, as we want to keep it as tight as we can to an hour, that obviously the team will come back to you individually and answer those questions if we're unable to get to them. So the first question that I'm going to ask is to Paul. This is from Michael. And Michael is asking, for British nationals living in Portugal, how do recent or proposed UK inheritance tax reforms affect expats? And what should they do to stay protected? Paul, if you're there, or
yeah, you can hear me.
Yeah, I can hear you.
So the UK government, the Labour government that came in, and Rachel Reeves, the Chancellor, brought in April, which will go live in 2027 in law, that basically the move from a domicile-based tax system to a residency-based one, which basically means that the 3.5 million people that expats that have built up wealth outside during their residency in Dubai or Portugal or wherever, they're going to be outside of inheritance tax after 10 years. But unfortunately, the people that are in the UK, their pensions and other things are going to be rolled up into inheritance tax. So we had a family recently where there were two two sons who've been running the family business for 20 years, but the name of the business was in the father, who was in his late 70s, 40 million business. And that under this new scheme, they potentially were going to get 35% inheritance tax, and then a similar number in terms of capital gains. And I believe there's another tax on top of that. So there are a lot of British people now that are emptying their pensions and investing outside of the UK, and Portugal is obviously one of those countries and an attractive option for many.
Thank you, Paul. This one again for you, Nuno. It's from a chap called Neil, and Neil's asking, if I already have a will from my home country, do I need a separate Portuguese one?
I don't think so. The reason why I would recommend that will to exist, so that there are no doubts what kind of law does the person want to apply to his inheritance. So what we have been doing in those cases, we don't really need a Portuguese will, because the will that they did in their home country should be okay. But for them not to be forced to follow the Portuguese rules, sometimes what we do, and we recommend that to be done, is to put in place a Portuguese will where that person just declares that he wants the non-Portuguese law or the citizenship law to apply to their inheritance.
I mean, thank you. I'm just looking at all these questions flooding in. Just to reiterate that, obviously, if we don't get a chance to get to all of them, our team will get back to you. Just looking through here, we have a question here, which Andreas, you can answer this one for me. This is from Mary. Mary's asking, when should I start planning my income and assets? I'm 3 years into my NHR tax regime and do not want to end up with a shock in terms of tax in year 11.
Hi, Mary. Thanks for the question, because it's an easy one to answer right away. That's to be fair, that's the long and short of it right away. Again, with a lot of planning things, if you have defined periods of time that an event is associated with, you know that you have that amount of time to be prepared. And so I'll just add to that base, just following on from what Paul was saying with regards to changes in the UK. So we have now defined knowledge of the fact that there's going to be a change to the pension taxation, although there's that still has to receive royal assent and get passed in Parliament. So a lot can happen, but it gives you an indication of the thinking of the government. The fact that they've done away with the domicile and introduced a residence-based inheritance tax regime means two things need to happen right now, and this also is for Mary with the 3-year question. So important to just initially take a step back and identify exactly what your current position is. Once you've established that, you're then in a position to identify two further paths of action. One is recognizing what are the risks that your current position presents to you from a tax planning perspective in terms of your legacy objectives, but equally, what opportunities rather? What are the opportunities that are apparent? Because in a lot of these legislative changes from a political standpoint, there are always risks, but there's always opportunities as well. And depending on your understanding of the impact on yourself, that gives you the opportunity to take control. So it's getting to understand what is it that you can control, what do you need to prepare for, and then take action.
Thank you, Andreas. I'm going to go for one more question before we sort of wrap up today. Paul, this one's that you can take this one for me. It's from Craig, and Craig has a temporary visa in Portugal, and he has to leave every 3 months because of the 90-day rule. He would like to give his children and grandchildren a European passport. So how long does it take how long does the golden visa, process take, and what kind of choices does he have in terms of investment funds?
Yeah, well, I mean, there's over 30 alternative investment funds. We have an index of those funds. The process is between 2 and 6 months to do the application process. Selecting the funds can be done during that process, and it takes as long as it takes for you to gather the documentation, like marriage certificates, and getting them getting those notarized and apostilled and criminal record statements. Now, we've seen it done in 2 months, but typically it's 4 to 6 months because people lives get in the way and they're slow sometimes to get back to the immigration lawyers. But that's the timing. But we're seeing a lot of people that are already in Portugal on that 90-day rule, and they want the flexibility of being able to come and go with only having to give 7 days in country, and they can also choose where they hold their tax status. So that might allow them to get their estate planning in place, and then maybe migrate from where they pay tax now to maybe NHR 2.0 or whatever is going to be right in terms of their desired outcomes.
Okay, thank you, Paul. Thank you. So again, as I said, we didn't get round to all those questions, so we will get back to you. Quite conscious of the time, and obviously people, like Paul just said, have got busy lives. So we hope obviously that this webinar has provided some clarity. But before we go, I just want to go around the room to each of the panelists and really just get them to give the audience sort of one sort of key takeaway, or something that they should take with them from this particular webinar. Paul, I'm going to start with you.
Plan early, act early, and get the best desired outcomes, basically, is what I would say.
Thank you, Paul. Nuno?
Yeah, as I mentioned, I think seeking advice from a Portuguese perspective, but also from the country from where they are leaving, to make sure that that no contingencies are left in that specific jurisdiction. And this is obviously mostly linked to tax, because becoming a Portuguese tax resident is not very difficult, because we have some our residency rules are quite tax residency rules are quite broad, but sometimes clients do not properly deregister as tax residents in the country where they used to live, and may end up with, at least at the beginning, with a situation whereby they are treated as tax residents in 2 jurisdictions, which is something that should not happen. And then we need to go into a bit more detail in tiebreaker rules from double tax treaties, which is, when we are in that position, it's already a bad position to be. So seeking advice from the country where they are leaving, and from Portugal, and from an inheritance perspective, as Andreas very well pointed out, I think that it's up to us also as advisors to make sure that we understand what is the main purpose, or what is the main objective that the client wants to achieve, and to help them navigate the differences between Portugal and the jurisdiction where they come from, for them to select the best legal framework to apply to their inheritance. So basically, as Paul mentioned, planning early, seeking advice, and making sure that they take the most out of the applicable regimes.
Lovely, thank you.
Steve, before you summarise, there's a few people sort of asking, well, if I don't get the pension thing anymore like I used to on the old NHR, as Andreas has said, if you talk to people early, there are different things you can do. You might not be able to do one thing, but you might be able to do something else. But if you don't start that planning early and talk to the right people, then you will have unintended consequences. Yeah, so I've seen a few things in the chat will say, well, I won't come then, because it's black and white, but it isn't black and white.
But it isn't because, again, obviously just tackling that, Paul. For example, we've seen clients that would have a kind of, they have an investment which would in principle in the future generate what we call a pension income. But if we do things in advance, for example, we can requalify that kind of pension income into an investment income, for example, which becomes completely exempt from tax in Portugal, and most likely in the UK as well. So as you were saying, Paul, I think that it's not black and white, and I think that as you mentioned in the chat to Chaco, there are other ways to make this work for you in Portugal. So I wouldn't be as drastic in terms of taking decision to stay in the UK based on something which it's not something that is it can be dealt with.
Absolutely. Thank you for clarifying. Andreas?
Yeah, well, I would say, especially based on just the last speak to a professional. There's not just one way pensions are considered and taxed in Portugal. So, there's many different ways of considering how pension taxation is applied with or without the NHR. So first thing is speak to a professional. But I would say, crucially, when it comes to the idea of your management of your wealth, the management of your estate, is to identify and focus on what it is that you've got control over. What are the things that you have the ability to exercise a degree of decision making that affects the outcome? So recognize and identify what those are. And then crucially, also have an appreciation and an understanding for the things that you may not have control over, and assess how do you best prepare for that. A very good example of that is a number of clients of mine that would, communicate to me that they potentially have the intention of, on the death of one of their partners, move back to the United Kingdom. And so, that's a common example of, you don't have control over the timing of these sort of things. Well, not greatly anyway. But you are in a position to how to prepare for it by understanding how you invest your assets now. What sort of wrappers, again, coming back to the wrappers, how do you use these? How portable are they? What will be the impact for you if that should happen? And so how do you construct things now, preparing for what you don't have control over? So if you do that, I think largely you cover all the bases.
Lovely. Thank you, guys. Some great takeaways there. We're going to wrap up now because, again, I can see people obviously leaving and obviously they've got busy lives. We will be sending out a recording and again, we will be obviously providing you with those links to book a discovery call should you want. We've got our next webinar, just before we go, on the 22nd of July. And again, that is specifically around securing Portugal's golden visa. Obviously, it's come up a little bit in the chat today. Very hot topic at the moment. Again, if you need to reach out to us for anything, would like to book a call with one of our experts or even indeed with the experts on the panel, so Andreas and or Nuno, please do so. The links have been in the chat. Until next time, we thank you for joining us, and big thank you to our panelists for providing their time today. I hope you found it all useful, and we'll see you soon. Thank you very much.